Will the market go up or down? Should you lock in or float? Find out this and more with Master of the Markets, hosted by Barry Habib of MBS Highway. Brought to you by Paramount Residential Mortgage Group.
Welcome to another edition of Master of the Markets. I'm Barry Habib at MBS Highway. It's created exclusively for NMP TV, and it's brought to you by our friends at PRMG. They're working for your best interest. Boy, last week was a volatile one as we saw mortgage-backed securities and treasuries in free fall. If you're not an MBS Highway subscriber, you may have been surprised by this, but MBS Highway subscribers knew well in advance and were protected all along the way because we saw this coming. You had the Fed minutes, and historically the Fed minutes are not a good thing. And we were about the only ones who called it correctly and said we thought that the Fed would be speaking about in their minutes the runoff of their almost $9 trillion balance sheet. And we thought that could upset the marketplace. So we were positioned beautifully ahead of it. And no one else apparently did, because they were all shocked on CNBC that the Fed mentioned this. Nobody was anticipating it. But the thing that the Fed said was they were going to consider allowing their balance sheet to run up. And that's the big one. Look, the tapering, that's gentle. But they're still reinvesting. The dirty little secret is $70 billion a month in mortgage-backed securities. People are typically shocked to hear this, but we've been talking about this forever. And in addition to that, the pace of the rate hikes may accelerate, now with a chance of even moving it up into the first rate hike happening in March. They call that liftoff, and then after that, they may actually consider doing a runoff of their balance sheet. Now, that's doing two things at once. That didn't work out well in 2018, and the bond market is fearful of that. Now, add some gasoline to that with a jobs report that on the headline didn't appear so strong, but when you look beneath the hood, this was a really good jobs report. It was expecting on the headline 450,000 jobs. It only came in at 199, so bonds should react favorably, right? Well, we again were positioned and locked ahead of it because we knew that there was strength within the report. What was the strength? It's in the household survey. You see, there's two surveys. There's a business survey and then there's a household survey. The business survey measures people coming on payroll and businesses being born or businesses being destroyed. That's the birth, death, or closing. That is one way to measure it. But these models don't oftentimes capture things quickly enough. And also, it doesn't capture something that the household survey does, which calls people. And that is self-employed people. People that are not waiting to go back to work, that are fed up with certain conditions at work, and that are going into business by themselves. And obviously, with all the tools that are available, it's easier than ever to do that. It's not captured in the business survey, but the household survey does capture it, where they actually call 60,000 households. None of these reports are perfect, but what we do see is that the unemployment rate, which is derived from the household survey, declined by 0.3% from 4.2 all the way down to 3.9. So unemployment rate under 4%, and there were 650,000 jobs creations. This was one of the cornerstones of why the bond market responded negatively, why this is a really strong report. But the other aspect of this that we have to consider is the inflation component. That's hourly earnings and weekly earnings. If you take the last 6 months, they're up 6%, and if you extrapolate the most recent data, over 7%. This is inflationary and sticky. Now, speaking of inflation, this week we got a couple of things happening. You're going to get a CPI report that everybody's going to be watching. We're going to forecast that this number, for the first time in a long time, on the headline will be over 7, and that the core rate will be over 5. That's going to get the bond market's attention. But in addition to that, the next day on Thursday, there'll be a 10-year Treasury note auction, and the 10-year Treasury is already at 175, breaking above resistance. If there's inflationary pressure, we think there will be, a 10-year Treasury auction might cause some volatility and a little heartburn for us if it continues to rise. Look, short term, maybe mortgage rates, they settle a little bit, but if we get more inflation, which I think we will, and if we be put in a position where we see the 10-year note auction be a little bit soft, we could be in for higher rates still. Stay tuned, get on MBS Highway, protect yourself, and don't go through the heartburn if you weren't on like you had last week. Talk to you soon.
PRMG continues to provide our wholesale partners across the nation with better technology, better product, better pricing, and better service. Our nationally recognized brand is more than just an image. It is a symbol of integrity. PRMG, built by originators for originators. Be sure to click on the link below for your free 30-day MBS Highway trial.